Okay, cool. So we're going to go into our versus topic. So what this is it's where we've got two topics that are as controversial as the other or are positive equals, and we're just going to debate them. We're just going to really understand what they are, what's the positives, what's the negatives, and what's the answer really. So first on that list is interest-only mortgage versus mortgage repayment. Which one is better? I'm going to start this one out, okay? Both of them have got two different purposes. Now, if you're living in a house yourself, you might want a mortgage repayment. So what's a mortgage repayment? It's where you're paying off the interest and the principal loan at the same time. Because someone that's living in their own house, they might want to pay their mortgage off at one point, okay? Now, if we're going to be a property investor, we might want to look at an interest-only mortgage, okay? So what's this? It's where you only pay off the interest every single month. You don't pay off the principal loan. Now, the one thing to note is once the interest has been paid off, the principal loan has to be paid in full, okay? But that's okay because that's where refinancing comes in. So we can refinance the property because at that time where the interest has now been paid off and it's now time to pay off the principal in full, that should have given you enough time to see the market increase through capital appreciation where we can go and refinance at a new value and therefore pay off the principal with a new interest-only mortgage. So benefit to doing interest-only mortgage is your payments are going to be basically split in half each month. So therefore you can achieve a much higher, rental income. So you've got more profit coming through. So as an investor, personally, I use interest-only mortgages. But if you were going to go and live in a house or you wanted, for whatever reason, to make sure that that mortgage can be paid off at some point, then a mortgage repayment is going to be better for you. Would you like to add anything?
Yeah, I mean, the whole idea of property investing is to stay in debt, okay? Keep the debt. Debt is good when it comes to property investing. So interest-only mortgages are the best ones because you're going to earn more through your rental income. And when it comes to the repayment, you can just refinance, okay, and keep that debt. So our aim is to die with debt, okay?
You look at Robert Kiyosaki, he's in about $5 billion worth of debt. But that $5 billion of debt makes him more than that. So it makes sense. Now, I'm going to just obviously quickly go into debt a little bit. To also help with the realization and maybe a mindset shift towards debt. We're told from such an early age that debt is bad. Stay away from debt, okay? But what you don't understand is there's two types of debt, bad debt and good debt. Okay, going to buy a car or going to buy a holiday or getting a conservatory built on the back end of your house and getting a loan for all of that is bad debt. Why? Because it doesn't make you any money. Where if we're going to go and buy a house, that's good debt. Because the money that we're putting down for the house makes us more money back. So there's a fair value exchange there. So when you're next going to go get yourself in debt, realize something. Is this actually making me a liability or is it going to be an asset? Is it going to make me money or am I going to have to pay out money? Okay.
Amazing. So the next one is self-managed versus fully managed. Now, at the start of your journey, I definitely recommend managing it yourself, because you're going to get an understanding of what you need to do, okay? And then if you do look at going managed, you know what needs to happen and what the manager needs to do, so the manager can't pull the wool over your eyes.
Which is very common in this industry. Unfortunately, there's a lot of incompetent, managers out there at the moment. So being able to understand the process for yourself through self-management at the beginning, you're going to understand what that process looks like rather than just giving it to a letting agent. Amazing. So I've got another point to be fair.
Yeah,
so at the beginning, when you're obviously... Did you want to go?
Yeah, well, I was just going to say, to answer the question, self-manage at the beginning, unless you've got a recommended manager and you haven't quite got the time. So if someone's recommended this management company to you and it's got good reviews, you're getting a good feeling from them, do it, okay? You can go for the managed. But if you're at the start of your journey and you're looking to understand the processes in and out, go through a self-management option at the start because it's going to give you that sort of benchmark of knowledge to take into the future.
Yeah, it also depends if you want active income or passive income. So if you actively want to be working and doing it, that's fine. We did. So you'll be hands-on at the beginning. Versus if you want it completely passive, then you're going to want to go down the fully managed route anyway. Okay, so it depends on your situation. Like I said, if you're going to scale it up, I'd just go down the managed route. The one thing to take into consideration is they will take a percentage of your turnover as their management fee. These can range depending on what strategy it is that you're doing. Only go with agents that have been recommended to you or you know they're going to do a good job. Because like I said, if you've got a bad manager, it's going to then have an effect onto your tenants and it's going to have an effect on you because you're going to have a high turnaround of people. Now, also take that percentage into consideration, see how well your portfolio is actually doing in regards to income. If you can't warrant giving that percentage to an agent, then you're going to have to go do it yourself. So you can save yourself a little bit of money. But this also, I'm going to go a little bit off topic here, but this also takes us back to understanding what you're worth as well. So you need to be able to work out what your hourly rate is. And if doing that job, okay, is, payable by someone else or is, below your pay per hour, then make sure you don't do it because then you're bringing yourself down a little bit to go and do versus giving it to somebody else and you having that time back to go and improve your business. Another thing you can do is if you are self-managed at the beginning and you understand the process very, very well, then when you do start to grow, and rather than giving a percentage of each property, you can pay someone full-time to come in and manage it. So they can come in and do the management, deal with the communications, the issues, the rent collections, the viewings, the advertisement, that whole side of the business. And you might actually be saving yourself some money. But the key thing about that is if you've already self-managed at the beginning, you're going to know the process. You're going to know what it is that you need to do, what it is you don't do. So therefore, you can train someone up to be another version of you rather than going out on a limb trying to find, agents and, testing the waters and bouncing from company to company to company until you...
Just add to that. So if you're doing rent to rent, I'd recommend self-managing, especially if you're doing HMO, because it's going to give you a great foundation of knowledge and you're going to be earning more money, okay? So if a HMO management company is taking 12%, that's going to eat into your profit unless you've got an absolute diamond of a deal. Don't get me wrong, serviced accommodation. We do know a lot of people that do rent to SA and rent to HMO that have got managers, but it all works back to the numbers. If it's viable to take on as a managed property and you want to do that, feel free to do it. However, if you're doing rent to rent, I'd highly, highly recommend self-managing. It's going to work out a lot better. You're going to learn all the skills. You're going to earn more money. It's definitely recommended to self-manage if you're doing HMO. If you're a busy business owner who's cash rich, time poor, and you're looking to build assets and add to your portfolio, look at getting a manager and look at scaling accordingly.
Okay, finance versus own capital. Which option to go down? Okay. Personally, I use finance. As we've already mentioned earlier, debt in property is good. You want debt to be your friend, okay? As long as the deal stacks and you've assessed the risk of going down that route. Now, I wouldn't recommend going down a finance option for a flip because let's just say you go and bridge it, okay? You're going to have to pay that bridging back at the end and it's on a high interest, repayment. But what about if you can't sell it? Then the risk is there. Versus if you're going to go do a BRR and you wanted to bridge it for that, then that's fine because you've understood the risk assessment and that's paying it off via the refinancing at the end with a mortgage. So that's okay to go and do. Now, I basically turn around and say that if you've got the capital in the bank, it's up to you. It's up to you if you want to invest your own money. Personally, I don't. I use other people's money. There's various ways we can do that. And if you are already a part of Trade Property's education platform, then you're going to understand how to do that too. So it comes down to your situation. 1, can you get finance? 2, do you even want to use your own capital?
Yeah, I'll add to that. I completely agree with Tom, if I'm being totally honest. We preach, don't use your own money, okay? There's multiple ways you can go.
That's how we teach as well.
You can go about not using your own money, okay? So if you are doing a BRR, raise the capital to qualify for bridging finance, then use bridging finance to pay for the house and pay for the refurb, and then once you've refinanced, pay everything off. If you're looking to do a flip and you want to dump your own money into that asset, you can do because the asset is now stored in property. The equity is stored in that. So unless the market crashes, and if it does, it's not going to go down by a lot, okay, you're not going to lose much money, okay? But if you've got a bridging loan for a flip and you can't pay it back, you can potentially screw yourself. So if you're looking to do a flip, buy it cash, buy it with your own money, okay? And if it does take 3 or 4 months to sell, it doesn't matter because you've added the value, you've increased the equity within the property, and now it's just sat there waiting, ready to be transferred. That is it, anything you'd like to add?
No. Okay, amazing. So thank you everybody for tuning into episode 2 of the Trade Property Power Hour. If you have genuinely enjoyed this episode, then make sure you follow it, you download it, and you give us a review. We're also going to be leaving the link below to our Trade Property webinar. This is a webinar we host every Wednesday at 7 p.m. for new investors and experienced investors that want to understand different strategies and how they can level up using our own methods. So I'm going to leave the link below. If that does sound of interest to yourself and you want to level up, then make sure you click it and register your details, and I will see you there.